Welcome back to the Options Academy. In this presentation, we'll discuss the concept of delta and how it is used in trading options. As always, to make the most of this presentation, we recommend that you refer to our written article at www.theoptionsacademy.com, which matches this video. So before we go ahead and advance to learn about credit spreads, we would like to take you on the short but important detour. Once you enter the circle of intermediate traders, you will often hear about the Greeks and about delta and its implications to your trading. This presentation will explain in simple terms the concept of delta and how you could incorporate and use it in your trading. Delta is one of several Greek symbols which have become known in the world of derivatives as the Greeks. These are a group of Greek letters which are used in options trading to describe the relationship between the option and factors influencing the option. Some of these factors include the relationship between the option and the underlying asset, the relationship between the option and the time left to expiration, the relationship between the option and volatility, and even the relationship between the option and the rate of risk-free interest rate. While this presentation will focus on one concept only, the delta, it is worth noting that the different symbols include some generally known and commonly used by option traders. Greek letters such as delta, gamma, theta, and vega, as well as more generally obscure terms and second-degree derivatives such as omega, which measures the change in an option's value resulting from a move in the underlying market in percentages. Rho, which measures the relation to risk-free interest rate, and charm, also known as delta decay, which measures the rate of change of the delta over time. As we mentioned, this presentation will focus on the Greek symbol delta. The complexity of the Greeks and the secondary Greeks deemed it irrelevant to the purpose of this presentation, which is to deliver an overview of delta and its practical issues in trading. Therefore, without any more delays, let's move on to our main guest, the delta. Delta is defined as the sensitivity of an option's value to change in the price of the underlying asset. In essence, delta is the manifestation of the market's influence over the option's value. Delta is measured from 0.0 to 1. When the delta of an option is 1, the value of the option will move in tandem with the underlying market. For every 1 point the underlying market will move, the option will gain or lose 1 point. On the other hand, when the delta of an option is closer to 0, the value of the option will hardly be changed at all as a result of a move in the underlying market. Where the option is in relation to the underlying market has great effect on the delta. See our comments about out of the money, at the money, and in the money options in our What Are Options article and presentation. The delta of a deep in the money option is approximately equal to 1. Therefore, a deep in the money option will move almost in tandem with the underlying market. The delta of a deep out of the money option approaches 0, and therefore a move in the underlying market will hardly have any effect at all on its value. The delta of an at the money option is approximately 0.5, and therefore an at the money option will gain or lose approximately 1/2 of a point for every 1 point move in the underlying market. Let's go over positive delta and negative delta. Delta is positive for bullish positions and negative for bearish positions. Therefore, it could appear with a positive sign, i.e. +1 or +0.5, and could also appear with a negative sign, i.e. -1 or -0.5. Being long the underlying market or being long calls or being short puts will create a positive delta. Therefore, if you buy the underlying asset, or if you sell a put, or if you buy a call, the delta of your position will be positive, which means to you that if the market goes up, you are gaining value. Being short the underlying asset, or being short calls, or being long puts will create a negative delta. Therefore, if you sell the underlying asset, or if you buy a put, or if you sell a call, the delta of your position will be negative, which means to you that if the market goes down, you are gaining value. It is important to note that the value of +1 and -1 relates to a unit of one option. Hence, if your position has 2 options, the delta on your position might be approaching +2 or -2. And if you have 5 options in your position, the delta may approach +5 or -5, and so on and so forth. It is also important to understand this because if the delta on your position is +2 or -2, your options position will gain or lose approximately 2 points for every 1 point move the market makes. If the delta on your position is +5 or -5, your options position will gain or lose approximately 5 points for every 1 point the market will move. Let's talk about delta and practical trading. Now that we understand the dry definition of delta and how it may appear on your trading reports, let's dive into deeper waters. Let's take a look at the relationship between delta and your option and understand how to use delta in practical trading and practical risk management. It is important to understand how options are affected by delta because delta can be used as a guideline. Delta can really become a pillar of fire traveling ahead of your position and giving it a direction. If the delta is too high or too low on your overall position, you could adjust your position by buying or selling options. By understanding the relationship between options and delta, you will be able to control your delta and your risk by taking the correct steps. We assure you that after 1 or 2 readings and after watching this presentation once or twice, you will be able to carry an intelligent conversation about delta in the next family gathering or club meeting. However, if you have any questions at all, or if you want to explore the concept more, feel free to contact us. We are sure we will be able to answer all your questions. Here's to your success, and remember, there is a substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results. And remember that only risk capital should be used. Hope to see you again soon.